If you are planning to retire anytime soon, there is a hidden tripwire buried deep in the IRS tax code that activates exactly on January 1st of the year you turn 63. Most people think age 65 is when the major health and tax rules finally change, but if you wait until 65 to start planning your finances, you have already fallen completely into the trap. Age 63 is the only year in your entire life where a single extra dollar in income could instantly cost you thousands of dollars in surprise taxes and penalties 2 years later. Over the next few minutes, we are going to unpack exactly why the IRS and Medicare treat age 63 differently than any other age in your life. I have spent years analyzing retirement taxation, sitting across from hardworking people and helping everyday folks protect their life savings from completely avoidable government penalties. Today, I am going to show you the exact mechanism the government uses to look back at your income, the incredibly common mistakes that trigger this massive penalty without you even realizing it, and most importantly, the specific steps you must take before you blow out your 63rd birthday candles to protect your wealth. We will cover the mechanics of this hidden tax, the difference between tax brackets and tax cliffs, the everyday financial moves that trigger the penalty, and the precise strategies you can use right now to keep your money exactly where it belongs, which is in your own pocket. Let us start with the core reality of what happens when you turn 63. To understand this, we have to talk about something the government calls IRMAA. That stands for the Income-Related Monthly Adjustment Amount. Do not let the boring bureaucratic name fool you. This is a stealth tax, plain and simple, and it targets middle-class and upper-middle-class retirees with absolute precision. You see, when you turn 65, you are going to enroll in Medicare. You will likely sign up for Medicare Part B, which covers your outpatient care and doctor visits, and Medicare Part D, which covers your prescription drugs. Most people assume that Medicare costs the same for everyone. They think they will just pay the standard base premium that they hear about on the news or read about in brochures. But that is not how it works at all. The government decides how much you are going to pay for Medicare based on your income. But here is the massive catch, and this is where the age 63 trap is sprung. When you turn 65 and apply for Medicare, the government does not look at what you are earning at age 65. They do not look at what you earned at age 64. Because of the way tax filing deadlines work, the IRS and the Social Security Administration look at your tax return from exactly 2 years prior. That means the income you report on your taxes during the calendar year you turn 63 directly and entirely dictates what you will pay for healthcare when you are 65. The year you turn 63 is your base year. It is your ultimate snapshot. Everything you do financially between January 1st and December 31st of your 63rd year is recorded, locked in a vault, and used against you 2 years later. Imagine this scenario. You have worked hard your whole life. You are 63 years old, and you decide this is the year you are going to transition into retirement. Maybe you sell a piece of property. Maybe you finally cash out some company stock you have been holding on to for decades. Maybe you take a lump sum from a pension, or you decide to take a large withdrawal from your traditional IRA to pay off your mortgage so you can enter retirement debt-free. In your mind, you are just doing some smart financial housekeeping. You pay your standard income taxes on that money, and you think the transaction is completely closed. Then you turn 64. Nothing happens. You feel fine. The coast seems clear. Finally, you turn 65. You fill out your Medicare paperwork, expecting to pay the standard premium of around $175 a month. A few weeks later, you open your mailbox and pull out a letter from the Social Security Administration. The letter informs you that because your income was considered high 2 years ago when you were 63, you are subject to IRMAA. Suddenly, your Medicare Part B premium is not $175. It is $350. Or maybe it is $450. Or even close to $600 a month. And your Part D prescription drug coverage gets slapped with a surcharge as well. Because Medicare premiums are generally deducted directly from your Social Security check, you suddenly notice that your Social Security payout is hundreds of dollars lighter than you planned for. For a married couple, both spouses get hit with this penalty. That means an accidental income spike at age 63 can easily cost a married couple an extra $5,000 to $10,000 out of pocket in a single year when they turn 65. And the worst part is, the government does not warn you when you make the withdrawal at 63. They just quietly take notes and send you the bill 2 years later. Have you ever stopped to calculate just how much hidden taxation is slowly draining the average retirement account? It is a staggering reality that millions of Americans are currently paying a massive penalty on their healthcare simply because they sold a mutual fund or took a withdrawal at the wrong time. This brings us to the crucial difference between a normal tax bracket and the age 63 tax cliff. This is the single most important concept to grasp if you want to protect your savings. The regular federal income tax system in the United States is progressive. Think of it like a series of buckets. When you fill up the 10% tax bucket, the extra money spills over into the 12% bucket. You only pay the higher tax rate on the money that actually spills over. If you earn $1 into the 22% tax bracket, you only pay 22 cents on that specific dollar. It is a fair system because earning more money always leaves you with more money in your pocket. IRMAA does not work like a series of buckets. It works like a cliff. When you are 63, the government calculates your modified adjusted gross income. They draw a hard line in the sand. Let us say, for the sake of example, the line for a married couple is $206,000. If your income at age 63 is $205,999, you pay the base standard premium for Medicare 2 years later. But if you earn just $2 more and your income crosses that threshold to $206,001, you step off the cliff. You do not just pay a surcharge on the $2 that crossed the line. That one extra dollar triggers a premium increase on your entire Medicare policy for the whole year. That single dollar of extra income at age 63 could cost you and your spouse over $2,000 in extra Medicare premiums at age 65. Ask yourself, if you earned one extra dollar today, would you ever reasonably expect to pay $2,000 in taxes on it? Because that is exactly how a cliff works, and it goes completely against everything we are taught about how taxes are supposed to function. This is why age 63 is a financial minefield. It is the only age where a single innocent financial decision can trigger a disproportionate, catastrophic penalty. So, what exactly triggers this trap? How do ordinary people accidentally step off the cliff at age 63? There are several incredibly common culprits, and most of them look like sound financial decisions on the surface. The first major trigger is capital gains from selling the family home. Many people reach their early 60s and decide the 4-bedroom house they raised their kids in is just too much to maintain. They decide to downsize to a smaller condo or a single-story home. The tax code gives you an exemption on the sale of your primary residence. $250,000 of profit is tax-free for an individual, and $500,000 is tax-free for a married couple. For decades, that exemption was plenty. But think about what has happened to the housing market recently. If you bought your house 30 years ago for $100,000, it might easily be worth over $800,000 today. If you sell that house at age 63, even after the massive tax exemption, you might still have $100,000 or more of taxable capital gains. That gain gets dumped straight onto your tax return, pushing your income right over the IRMAA cliff. You thought you were just simplifying your life, but the IRS saw a massive income spike. The second massive trigger is actively managed mutual funds held in regular taxable brokerage accounts. This one is incredibly frustrating because you do not even have to do anything to trigger it. If you own actively managed mutual funds, the fund manager inside the mutual fund is constantly buying and selling stocks. At the end of the year, usually in December, the mutual fund is legally required to pass the capital gains from those internal trades directly on to you. This is called phantom income. You did not sell any shares. You did not put a single dime of cash into your pocket, but in the eyes of the IRS, you received taxable income. Every December, millions of retirees receive unexpected capital gains distributions. If this happens to you during the year you turn 63, that phantom income could perfectly push you over the cliff, resulting in thousands of dollars in Medicare penalties, all for money you never even asked to receive. The third trigger is large, unplanned withdrawals from traditional IRAs or 401ks. When you put money into a traditional 401k during your working years, you got a tax deduction. The deal you made with the government was that you would pay the taxes later when you took the money out. Well, at age 63, later has arrived. Every single dollar you pull out of a traditional retirement account counts as ordinary income. People often decide to buy a new car, pay off a lingering debt, or help a child with a wedding when they are 63. They pull $30,000 out of their IRA to do it. That $30,000 sits right on top of their other income, driving them straight over the IRMAA threshold. We are about to cover the single most powerful, absolutely critical strategy you can use to permanently shield your money from this trap, which involves a specific window of time you must take advantage of before your 63rd birthday. But before we get to that master strategy, we have to look at the other reason age 63 is a profoundly dangerous year: the Social Security earnings test trap. Many people choose to claim their Social Security benefits as early as possible, which is age 62. The psychological pull of finally getting that check is strong. However, if you claim Social Security at 62, but you are still working a part-time job or doing some consulting work at age 63, you run straight into a buzzsaw called the earnings test. If you earn over a relatively low threshold, usually around $22,000, the Social Security Administration will begin withholding $1 of your benefits for every $2 you earn above that limit. Imagine you claim your benefits at 62, and at 63 you decide to work as a consultant, earning $40,000. The government will look at that income, apply the earnings test, and start withholding thousands of dollars from your Social Security checks. To make matters worse, that $40,000 of consulting income is also pushing up your modified adjusted gross income, which is secretly laying the groundwork for your Medicare penalty 2 years later. You are getting squeezed from both sides. You are losing your current Social Security benefits because you are working, and the money you are earning from working is going to drastically inflate your healthcare costs when you turn 65. Age 63 becomes a perfect storm of invisible taxation. Now, how do we fight back? How do we disarm this trap and protect your hard-earned wealth? You cannot just wait until you are 64 to figure this out. By then, the concrete has dried. The numbers are locked in. The absolute best way to survive the age 63 tax trap is to realize that your preparation must begin in the golden window between age 59 and a half and age 62. Why is age 59 and a half the magic number? Because that is the exact moment the IRS allows you to start pulling money out of your retirement accounts without a 10% early withdrawal penalty. And why is age 62 the end of the window? Because age 63 is when the Medicare look-back begins. Therefore, those 3.5 years, between 59 and a half and your 63rd birthday, represent the greatest tax planning opportunity of your entire life. During this golden window, your goal is to deliberately recognize taxable income on your own terms. If you have a large traditional IRA, you know that money is a ticking tax bomb. If you wait until you are 63 or older to take it out, it will spike your Medicare premiums. But if you execute systematic Roth conversions during your late 50s and early 60s, you completely change the game. A Roth conversion is when you move money from your taxable traditional IRA over to a tax-free Roth IRA. Yes, you have to pay income taxes on the amount you convert, but during that golden window, before the age 63 look-back begins, you can control exactly how much you convert. You can fill up the lower tax brackets intentionally. You might decide to convert $50,000 a year at age 60, age 61, and age 62. You pay the taxes at known low rates. By the time you wake up on the morning of your 63rd birthday, a massive portion of your wealth has been completely relocated into a Roth IRA. And here is the absolute beauty of a Roth IRA. Withdrawals from a Roth account do not count toward the Medicare IRMAA calculation. They are completely invisible to the formula. By prepaying the taxes during your golden window, you enter age 63 with a clean slate. You can pull $50,000, $100,000, or even $200,000 a year out of your Roth IRA at age 63, and your modified adjusted gross income will officially be reported as zero. When you turn 65, Medicare will look back at your income at 63, see nothing but tax-free Roth withdrawals, and award you the lowest possible standard premium for your health care. Another incredibly powerful tool to use during age 63 is an HSA, or health savings account. If you had access to an HSA during your working years and you funded it, age 63 is the perfect time to use it. Money pulled from an HSA to pay for medical expenses is completely tax-free and completely invisible to the Medicare look-back calculation. If you need a hip replacement or extensive dental work at age 63, do not pull the money from your traditional IRA. Pull it from the HSA. You must also rethink where your cash lives. Before you turn 63, you should be building up a significant cash reserve in standard checking or savings accounts. Why? because spending the principal of your own cash does not generate taxable income. If you have $100,000 in a checking account, you can live off that money for an entire year at age 63. Your tax return will show practically no income, cementing your low Medicare premiums for the future. You are essentially using cash, Roth IRAs, and HSAs to build an invisible bridge over the dangerous waters of age 63. But what if you are listening to this and it is already too late? What if you are 64 or 65, you just got the letter from the Social Security Administration, and your premiums have doubled because of something that happened when you were 63? I want to share the ultimate protective measure, the secret weapon that the government rarely volunteers information about. It is called Form SSA 44. The government actually acknowledges that looking back 2 years can sometimes be deeply unfair, especially if your life has drastically changed since you were 63. Form SSA 44 is the life-changing event form. If your income at 63 was artificially high due to a specific recognized life event, you can legally request that the government ignore your age 63 income and instead use your current lower income to calculate your Medicare premiums. What counts as a life-changing event? The IRS is incredibly strict about this. You can use this form if you or your spouse stopped working or reduced your work hours. You can use it if you lost an income-producing property due to a natural disaster. You can use it if you got divorced or, tragically, if your spouse passed away. If you had a massive income year at 63 because you were working full-time, but now you are fully retired at 65 and living on a fraction of that income, you do not have to just accept the penalty. You file Form SSA 44, provide proof that you retired, and the government will wipe away the IRMAA surcharge, potentially saving you thousands of dollars almost instantly. However, you must be exceptionally careful because the government strictly defines what does not count as a life-changing event. Selling your house at age 63 and generating a huge capital gain does not count. Doing a massive Roth conversion at 63 does not count. Selling mutual funds does not count. Taking a one-time lump sum from your IRA to buy an RV does not count. In the eyes of the government, those are voluntary financial choices, not life-changing events. If you trigger the penalty through voluntary choices, there is no appeal. You simply have to write the check. Retirement is supposed to be a time of peace, a time when you finally step off the treadmill and enjoy the wealth you spent 4 decades carefully building. It should not be a time where you live in fear of your mailbox, terrified of what stealth tax the government is going to hit you with next. The entire financial industry focuses so heavily on how to save money for retirement, but they completely fail to teach people how to withdraw that money safely. Age 63 is the ultimate test of your withdrawal strategy. Let us briefly recap the absolute most vital takeaways from everything we have covered today. First, remember the 2-year look-back rule. The income you report on your taxes at age 63 is the exact income used to dictate your Medicare premiums at age 65. There is no escaping that timeline. Second, beware the cliff. The IRMAA penalty is not a progressive tax bracket. It is a rigid line in the sand where a single extra dollar of income can trigger thousands of dollars in unavoidable fees. Third, watch out for the hidden triggers. Selling a home, phantom mutual fund distributions, and traditional IRA withdrawals are the most common ways everyday people accidentally step off that cliff. And finally, utilize the golden window. The years between 59.5 and 62 are your primary opportunity to execute Roth conversions, pay your taxes on your own terms, and ensure that by the time you reach 63, your taxable income is as close to zero as legally possible. You have worked entirely too hard for your money to lose it to a bureaucratic trap that could have been avoided with simple foresight. Financial freedom is not just about how much money you make. It is absolutely about how much money you are allowed to keep. I know navigating the tax code can feel incredibly overwhelming, especially when the rules seem designed to catch you off guard. I want to hear directly from you. Leave a comment down below and share your experience. Have you or someone you know ever been blindsided by a massive Medicare premium increase? Or are you currently trying to figure out how to navigate your income as you approach age 63? Your stories help others realize they are not alone in this fight. Keep protecting your wealth, keep planning ahead, and take control of your financial future.